Hey traders, this is Blake Morrow with Trader Summit, and it's Friday, and we have Jim Welsh from Macro Tides. How are you, Jim?
I'm good, Blake, and I hope you're doing well too.
I am. What a crazy week. There's a lot to really unpack this week.
Yeah.
And I know that's a very common saying. We got a lot to unpack, but
Yeah.
really this week,
it's far more true this week than many others.
It really is. I mean, we had the Fed, we had the RBA, we had actually the Bank of England. We had a lot happening, and we had massive volatility this week. Matter of fact, just a little while ago on this Friday, we pushed, challenging the lows of the year in the S&P. It looks like we got a little bit of a bounce, but let's before we get into all that and how you feel about the markets, because we are going to look at some of your charts. I know you brought some charts for us to look at, but let's talk about the big kahuna, the Fed, and what happened on Wednesday with the Fed, and your thoughts and ideas moving forward.
Yeah. Well, as we know, the Fed raised the funds rate 50 basis points. There was some speculation that they might do 75. And so either at this meeting or June, and when Powell took that off the table, the stock market rejoiced. In my May 2nd, this past Monday, weekly technical review, I addressed that. I said, they're not going to do 75 basis points because they haven't telegraphed it. So the forward guidance of the Fed is something that people really need to pay attention to and listen to what the different Fed people are saying. And so to me, 75 was never on the table because no one had really talked about it other than Bullitt. And you need more than one guy for something to happen. So the market rallied hard. I thought that the S&P could rally to 4,300 and it got to 4,307, I think. Then quickly reversed, I think, as people began to realize this doesn't change the course of monetary policy. So as I've been saying for weeks, the hurdle that the market has to overcome is the economy is going to slow, and because the Fed wants it to, and we're going to still see the Fed talk hawkishly and raise rates. We've seen a compression in PE ratios from the increase in Treasury yields and the short-term rates that are coming. The next shoe to drop, I believe, Blake, is as the economy slows, we're going to see more and more Wall Street analysts cut earnings for the second half of this year and for 2023. So the next compression of PEs is going to come from lower earnings. And once we're done with that, I think the market is in a much better position to have a more sustained rally rather than these very short, terrific rallies that are basically bear market rallies.
Well, I want to first of all tip my hat to you for a couple of things. First of all, you were one of the people that months ago you talked about the Fed front loading rates, and I know for a lot of people 6 months ago they weren't even talking about quarter point rate hike, and here we are, Fed's raising rates half a basis point. It looks like they're going to do it multiple times into this year. That might even be their more common until they reach their target. That's going to be their path moving forward. So I'm going to tip my hat to you for that. Also, you had talked for, when we were at the 200-day moving average in the S&P, you still believed the S&P would actually trade down below 4,100 towards the new lows and towards 4,000. And I was thinking at that time, I don't know if I see that. But lo and behold, today we traded below 4,100, and here we are. So I guess I got to get your thoughts on the S&P where we're at. So I'm going to pull up the charts that you brought us because I'm now if I wasn't interested a few months ago or a few weeks ago, excuse me, when you talked about it, I am interested in it today. So here's the S&P. What are you seeing here?
Okay, just to touch on, thank you for the hat tips. Appreciate that. Again, if you've been in this business less than 20 years, you don't understand what the monetary policy is all about. I mean, that's the reality. In part because for the last 20 years, the Fed has been extraordinarily accommodative the vast majority of time. And so with inflation at a 40-year high, Blake, they don't have any options other than to raise rates. And we're going to see an interesting thing next week, and we'll talk about it in a second. Anyway, S&P, the expectation was that we would get a rally, and I had advised my subscribers to buy the S&P under 4150. As we can see in February, it got under 4150. When it was up near 4,600, I said, hey, we got 3 waves up, A, B, C. This is a good place to take some money off the table. because the expectation was, in all likelihood, we were going down and taking out 41.15. This morning, the S&P made a higher low than Monday, by 5 points. Neil Kashkari, who is the most dovish member of the FOMC board, gave a speech this morning, and there are like 6 Fed members talking today, and said, if things turn out okay and labor market improves or eases up, we may only have to raise the funds rate to 2%. And the market immediately rallied. So this is why I always say you have to know who the members of the Fed are, dovish or hawkish, and then take their comments within that framework. And
but, but the market reacted to that because he is a dove, and
people want to believe this crap. I mean, the reality is most people who've been in the business 20 years really don't know enough about monetary policy to understand the situation we're in. And I think that's going to continue. The CPI report comes out next week. I believe, and I've written about this for like 3 months, that we're going to see a peak in the CPI either in March and April, and it's going to come down a little bit. The key is it's not going to come down very much. But if indeed that happens, Blake, and we see the CPI be 0.1% or some details within the report are a little bit softer than they were previously, people are going, peak inflation. Oh my goodness, the Fed won't have to tighten as much. That's ludicrous, because a peak in inflation at 8.5 is much different than at 3.5. So again, I think there's a potential on the S&P that we will rally, put at least to 4,200 and up to 4,300. And we might actually take out the 4,308. And then all it's going to be is another big ABC. And then I think there's another decline coming.
Okay, so now in recent months, Jim, you talked about us hitting around these levels where we're at around the 4,100, maybe even towards 4,000, and then rallying to all-time highs. So now it seems like you think that we might be stopped shy of that on this next bounce. Is that correct?
Yeah. No, I think, as I just said earlier, we've seen a compression in PE ratios based on interest rates. I think the next thing that comes is a compression of PE ratios because Wall Street starts to lower earnings estimates for the second half of this year and next year. Once that's out of the way, then I think the market is on a much firmer ground. The 382 retracement of the rally from March 2020 to the high this last January is 3850. So to me, that's where I think we potentially, the S&P can get down to around those levels that I'd say, hey, time, anything under 3,900 or around 3,900, it's time to start, I think, committing, money and increasing exposure.
Okay.
I just don't think we're there yet because we're going to see data, Blake, showing the economy slowing, and the Fed is going to continue to talk hawkish and raise the funds rate by 50 basis points. I think at some meetings, they like sticking with the round number. And that's one reason why they didn't do 75 or consider it. Because if you go 50 and then 75, and then all of a sudden everybody's guessing game, they want to do a nice steady path, and that's why I think they're going to stick with the 50 basis points.
All right. Well, let's turn our attention to the TLT. You brought this chart up. What do you feel about this? Because I mean, we just saw 10-year yields actually just hit new highs today.
Yep.
The bonds are obviously under pressure. What do you think here? Do you think we get some reprieve? Do you think the bond market bounces a little bit? I mean, what are your thoughts?
I do, but we're not quite there yet. This is a term chart. It shows the lows back in 2018 in the fall, about 112 on the TLT. So I think, okay, that's a place where we can look to. The chart, the bottom panel shows, is it overbought, oversold? You can see historically it's very oversold. Okay. So that's the ingredient. If I'm right and we start to see data coming in showing the economy slowing, my expectation would be is the bond market will find initially some stability. And then I think we'll see a rebound in TLT back up towards 120 to 123-ish. But I don't think we're done, on the downside yet.
Okay. And, just eyeballing your chart, I'm looking at that number 2 peak, which, comes in around mid 2020 down to the early 2021 lows. That equal leg is pretty close to where we're at right now. I mean, if you took that distance and then we went to the peak in 2021 to where we're currently at, about an equal leg move. So, maybe that, just helps a little bit of confluence as far as support.
It's just, hey, the more things you can bring together, as you approach price level, to me provides some level of conviction. But obviously what we're going to need to see, I think, is again, lower lows, a bounce, and divergences. And ultimately, we talk about this a fair amount, the 5-day exponential, 13-day exponential. This is a weekly chart. So on a daily basis, looking at the 5 and 13-day exponentials of TLT and looking for a crossover where the 5 crosses above the 13. So there's work to be done here over the next few weeks, I think, before we can legitimately expect a price reversal. But I think there's a bounce coming. You just have to wait for this thing to, finish what it's been doing.
Okay, well, and one of the big tailwinds for the dollar has been this rally in yields or sell off in bonds, and so you bring up this chart of the euro. This is your longer term chart of the euro dollar.
Yep.
The euro's been under pressure, but I have to say, we've held 105 pretty well. But all things considered, the euro is holding up not so bad. And I'm not saying that the euro should be at 120, but I would have thought we'd be at parity by now. But what are we looking at here?
Well, this is just the two legs equal. In other words, from the high in early 2018, the low in 2020, and then you take that length, and we did this last week, from the high in early 2021, and it projects to about 104.30. Two legs equal.
Kind of what we were just looking at in bonds, similar equal leg.
Yes, same idea. Yeah. And then the low back in 2017 in January was 103.40, I think. All right. So we're coming into this range where you have two measuring targets that I think are important. This is, again, I think a monthly chart. The RSI is getting kind of oversold, not as oversold as it was back in 2015. That was an enormous decline, as you can see, continuously for about 15 months.
Yeah.
The point being, it's oversold. So to me, this is one of those things where it's like, okay, being short, I think no longer makes any sense. And now it's a question of waiting for things to set up. And we can look at the daily chart. And again, you can see the bottom panel RSI is pretty oversold. We're getting a bounce. I think potentially there could be, I'm looking, the odds favoring one more drop down towards that 104 level to complete some kind of a wave 5. And if we get a lower low and the RSI fails to confirm, all right, that'll be one, very important piece of the puzzle. And then the red line is the 5-day exponential, the green is the 13-day. And, to confirm that a trend change has developed and in place, you need the red line to get above the green line. So to me, I think it's time to be like, okay, looking for lows. Ideally, we'll see one more thrust down below the recent low of the last 6-7 trading days, get a divergence, and then see what happens then. So I just think it's time to begin looking for an entry. Back when it was at 108.50, I thought that was an entry. We talked about this last week. Got a bounce, but the red line didn't cross above the red, and then you took out the prior low.
Well, and I want to play devil's advocate here. Just looking back, I mean, even back in March, April, or even back in January, February, we've had the red line cross over the green line, and it, just failed to materialize any type of significant bounce. So what would make it different here? Just that.
Where it has to, get above and then stay above. Again, you're looking at a trend following type basis. This methodology, 5 versus 13, I think is pretty good because it's short term in nature, and it keeps you out of big trouble. So. And then, when you get a failure, like we've seen, and you just pointed out, Blake, you look at a prior price low and you take that out. Well, that has to be where your stop is. Or, you do a 618, you get a bounce. Well, what's the 618 retracement? You get much below that 618 retracement, and it hasn't gotten above, the red line hasn't gotten above the green line. That's problematic. So to me, this is how you just try to manage the risk of trying to find a bottom in in this case, the euro, which has been in a downtrend, much like the treasury, the TLT, been in a downtrend. You look for divergences, then price reversals to be able to confirm it. And then you have to have your stops adjusted accordingly.
Got it. Well, Jim, I love how you put everything together. And like I said, I'm hat tip to you today with some of your recent calls. I always love listening to you every week, and I know a lot of our traders do, but for those traders that don't, first of all, give Jim a big thumbs up if you're watching us on YouTube, subscribe to the channel, all that fun jazz. But Jim, how do I follow you and your work?
Macrotides.com or Jim Welsh Macro at Gmail. And if you write me and say, I watched you and Blake the other day and I liked it, if you do that, I'll send you a free copy of a recent publication.
How about if I don't talk like a gangster like you?
That's okay too.
Okay. All right. Good. All right. Just checking. All right, Jim. Hey, thanks for joining us as always on Fridays. I love our talks and our conversations. Have a great weekend, and we'll see you next week.
You got it, Blake. Take care.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.